You've been told a bank got caught laundering drug money and paid for it. The number attached to that story, $1.9 billion, sounds enormous. It is not enormous. It is a rounding error. The real driver isn't the size of the fine. Beneath the headline number, a different financial logic is operating, one that explains why the punishment for one of the largest documented money laundering failures in banking history looked from inside the institution like a routine cost of doing business. HSBC Holdings, December 11, 2012, $1.921 billion. That is the headline. What the headline compresses into a single figure was actually 5 separate instruments signed the same day by 5 different authorities. $1.256 billion forfeited to the Department of Justice, $500 million split between the Office of the Comptroller of the Currency and the Financial Crimes Investigation Network, and $165 million paid to the Federal Reserve as a civil penalty, the largest the Fed had ever assessed for anti-money laundering violations. None of those 5 instruments was a criminal conviction. HSBC signed a deferred prosecution agreement. That is a promise of future good behavior offered in exchange for charges that are drafted, filed, and then suspended, not tried. You watch that distinction blur in almost every retelling. The bank was fined. No, the bank was not fined. The bank was permitted to forfeit money it had already made from a crime it had already admitted committing in exchange for the government declining to prosecute it as a crime. Here is the pattern you've likely already half noticed from HSBC and from a dozen stories since. A large financial institution is found to have committed serious, sustained, systemic violations. The penalty, when it lands, is large in absolute terms and small relative to the institution's size. No senior executive faces personal criminal liability. The institution continues operating largely as before. Financial historians and legal scholars have a name for what you're describing. It is not one concept, but 3, layered on top of each other: moral hazard, regulatory capture, and the doctrine that came to be known informally as too big to jail. The last major time this exact configuration appeared was not really 2012, it was 2008, and the mechanism underneath both episodes traces back further still, to a structural feature of banking that Hyman Minsky described decades before either crisis happened. You were a compliance officer at a mid-sized bank branch in Mexico in the mid-2000s. Cash arrives, not wired, not electronic, physical cash, in volumes that don't match the stated business of the account holder. According to the U.S. Department of Justice's sworn statement of facts attached to the 2012 Deferred Prosecution Agreement, the Sinaloa Cartel and Colombia's Norte del Valle Cartel designed cash boxes specifically shaped to slide under HSBC Mexico's teller windows. That detail is not journalistic color. It is in a federal court document. Between 2006 and 2010, at least $881 million in drug trafficking proceeds moved through HSBC's U.S. correspondent banking channel without being detected or stopped. You would expect this to have been invisible, undetectable, buried under legitimate transaction volume. It was not. The U.S. Senate Permanent Subcommittee on Investigations released a 339-page report in July 2012, U.S. Vulnerabilities to Money Laundering, Drugs, and Terrorist Financing, HSBC Case History, documenting that HSBC Bank USA processed $670 billion in wire transfers and $9.4 billion in bulk cash from its Mexican operations without automated monitoring adequate to flag the risk. The bank's own regulator, the OCC, had flagged deficiencies in HSBC's anti-money laundering program across 4 consecutive examination cycles, starting as early as 2003, without those findings producing a consequence that changed the bank's behavior. This is the detail that matters more than the size of the eventual settlement. The system did not fail to notice. Compliance officers filed reports. Regulators issued findings. A consents order followed in 2010, ordering the bank to fix exactly the gaps that had already been identified. None of it interrupted the underlying business relationship. The gap wasn't between wrongdoing and detection. The gap was between detection and consequence. You need to understand what too big to jail meant as an actual argument made inside government, not as a slogan. In the lead-up to the settlement, UK Chancellor Osborne's department raised concerns with US authorities that a criminal indictment of HSBC could destabilize the bank and, by extension, the broader financial system it was interconnected with. No public evidence was produced to substantiate that specific claim, but the argument itself did the work. It reframed the choice facing prosecutors from "should this institution be punished for this conduct" to "can this institution absorb a punishment without breaking something?" Once that reframe takes hold, size stops being an aggravating factor in the offense and becomes a mitigating factor in the sentence. The bank does not have to argue its innocence, its balance sheet argues for leniency on its behalf. This is where the historical record becomes useful, because this exact inversion, where scale converts culpability into fragility and fragility converts into protection, is not new and it is not unique to HSBC. Between 1986 and 1995, more than 1,000 savings and loan institutions failed in the United States, following a wave of deregulation, risky real estate lending, and outright fraud. Unlike the 2012 HSBC settlement, the S&L crisis produced over 1,000 criminal convictions of bank officers and executives, according to Justice Department records from that era. The institutions involved were, individually, far smaller than HSBC. There was no single entity whose failure threatened the wiring of the global financial system. Prosecutors did not face the argument that indicting a savings and loan could bring down international banking. The absence of systemic interconnection meant the absence of the too-big-to-jail defense, because there was no too big to invoke. The comparison isn't that the 1980s prosecutors were braver, it's structural. Scale itself, once an institution is large enough to be load-bearing in the financial system, generates its own legal insulation. Charles Kindleberger, in Manias, Panics, and Crashes, 1978, described a recurring feature of financial crises. As institutions grow large enough to be systemically important, the cost of letting them fail rises faster than the cost of tolerating their misconduct.
Kindleberger was writing primarily about liquidity crises and asset bubbles, not money laundering specifically, but the underlying incentive structure he identified, that authorities become reluctant to impose consequences proportional to the offense once the offender is systemically load-bearing, is the same mechanism operating in the HSBC decision nearly 35 years later. You've heard moral hazard used as a term of disapproval, as though it describes greed. It doesn't. Moral hazard describes a pricing distortion. It occurs when an actor is insulated from the full consequences of a risk, so their incentive to price that risk accurately collapses. Apply that definition to HSBC's board and senior management in the years before 2012, not to the tellers who processed the cash. If the plausible downside of tolerating a weak compliance program is a monitored deferred prosecution agreement and a payment equal to a few weeks of earnings, and the plausible upside is years of high-margin, high-volume business in a market other banks were unwilling to touch because of exactly this risk, the rational institutional response is not to fix the problem aggressively, it's to treat detection as a cost center to be minimized, not eliminated. Who benefits from this arrangement? Shareholders retain the earnings generated during the years of lax compliance. Those earnings are not clawed back. Senior executives retain their positions. None were criminally charged individually in connection with the settlement. The government gains a monitored institution and a large one-time payment that it can present publicly as accountability. Who absorbs the cost? Diffusely. Taxpayers, in the form of a financial system whose next systemically important institution now has documented precedent that its own scale will be treated as a reason for leniency, and, more directly, the communities on the other end of the laundered money, where cartel violence in Mexico continued to be financed in part by capital that needed exactly this kind of channel to become usable. Compare HSBC to the Bank of Credit and Commerce International, BCCI, which collapsed in 1991 after regulators in the US and UK found it had been used for money laundering, fraud, and the financing of arms deals on a massive scale. BCCI was not a small institution. At its peak, it operated in over 70 countries, but it lacked the deep interconnection to the U.S. domestic payment system and the dollar clearing infrastructure that HSBC had. When U.S. and U.K. regulators moved against BCCI, they shut it down entirely. It ceased to exist as an institution. There was no deferred prosecution agreement because BCCI was not deemed too enmeshed in the plumbing of the global financial system to be removed from it. The lesson embedded in that contrast is not that BCCI's executives were treated more harshly because their crimes were worse. In several respects, HSBC's documented conduct, the volume of cartel cash, the multi-year duration, the number of prior regulatory warnings ignored, was comparably severe. The difference was structural position. BCCI could be excised. HSBC, by 2012, could not be excised without, in the judgment of the officials involved, risking damage to the correspondent banking relationships that much of the global dollar system depends on. Ferguson, in The Ascent of Money, 2008, traces how the modern banking system evolved specifically towards this kind of interconnection: correspondent banking, clearing relationships, cross-border settlement, as a feature that increases efficiency and simultaneously increases systemic fragility, because it means individual institutional failures propagate rather than staying contained. The Assistant Attorney General overseeing the criminal division at the time of the settlement acknowledged publicly in comments accompanying the December 2012 announcement that prosecutors had weighed the potential destabilizing effects of a criminal conviction on the broader banking system as part of the charging decision. That acknowledgement, made openly rather than concealed, is itself the data point worth sitting with. This wasn't a case of the government failing to notice the tension between punishment and financial stability. It was a case of the government stating, on the record, that financial stability considerations shaped a criminal charging decision involving admitted laundering of cartel proceeds. Jesse Eisinger's The Chicken Shit Club, 2017, an account of the Justice Department's declining rate of individual prosecutions against financial executives after 2008, documents a broader institutional shift inside the DOJ during exactly this period: a growing internal culture of risk aversion around bringing criminal cases against large financial institutions and their executives, driven partly by a string of prior prosecutorial losses and partly by genuine uncertainty about collateral economic damage. Eisinger's core finding, based on internal DOJ interviews and case records, is that this shift was not a single policy, but an accumulated institutional habit, meaning the HSBC decision wasn't an isolated judgment call. It was one data point in a pattern that had already been forming for years before 2012 and continued shaping enforcement decisions well after it. Why it's false? A penalty's deterrent effect isn't a function of its absolute size, it's a function of its size relative to the gain it's meant to offset and the probability that the offending behavior gets caught and punished at all. HSBC's own analysts described the settlement's impact on the bank's book value as trivial at the time. A cost that is absorbable within a few weeks of ordinary earnings does not function as a deterrent in the economic sense. It functions as a price, and a price, unlike a deterrent, is something a rational actor pays and then continues the underlying behavior around, adjusted only enough to avoid detection next time, not eliminated in principle. Myth: this was primarily a story about one bank's individual wrongdoing. Reality: the enforcement pattern generalizes across the sector in the same period. Why it's false? Standard Chartered, Credit Suisse, Barclays, ABN AMRO, and BNP Paribas all reached comparable settlements with U.S. authorities over sanctions or anti-money laundering violations in the years surrounding the HSBC case, several involving deferred or non-prosecution agreements rather than convictions. Reinhardt and Rogoff, in This Time is Different, 2009, a study spanning 8 centuries of financial crises across dozens of countries, found that institutional responses to systemic financial misconduct consistently underestimate how similar each new crisis is to the ones before it, because each era convinces itself its own institutions and instruments are structurally different from history's. The HSBC case fits that finding precisely. Each settlement was treated in isolation, described in its own press cycle as an anomaly, when the underlying enforcement logic, scale converts to leniency, was operating identically across the entire sector.
Myth: the deferred prosecution agreement and 5-year monitorship meant the problem was fixed. Reality: an investigation by the International Consortium of Investigative Journalists published in 2020 using leaked FinCEN documents found HSBC continued processing transactions for entities linked to alleged fraud and criminal networks during the monitorship period itself. Why it's false? A monitor can verify that new compliance procedures exist on paper. It has a much harder time verifying that an institution's underlying incentive structure, the calculus of which business relationships are profitable enough to tolerate residual risk, has actually changed. The ICIJ's FinCEN files reporting found that between 2013 and 2017, HSBC's own compliance staff filed reports lacking crucial customer information on shell companies that had processed nearly $1.5 billion through the bank's Hong Kong operations, with more than $900 million of that tied to entities linked to alleged criminal networks. That period sits entirely inside the 5-year window the bank was supposed to be under heightened court-ordered scrutiny. Myth: because no HSBC executive went to prison, no accountability mechanism exists for this kind of institutional failure. Reality: the accountability mechanism that does exist is reputational and regulatory, not criminal, and it operates on a different timescale. Why it's false? HSBC's group head of compliance resigned publicly during the Senate hearing in July 2012 before the settlement was even finalized. The bank's probation was ultimately extended rather than lifted on schedule, and the FinCEN files reporting reopened public and regulatory scrutiny years after the original agreement expired. These are real consequences. They are simply not criminal ones, and they don't fall primarily on the individuals who made the underlying decisions. The mechanism that exists targets the institution's reputation and its regulatory relationship, not the personal liberty of the executives who set the risk tolerance that produced the conduct in the first place. You are a compliance officer again, but now it's 2013, inside the 5-year monitorship. You know the institution has more time than you do. The monitor's mandate has an expiration date, 5 years, set in advance. The bank's incentive is to demonstrate adequate improvement by the review dates that matter, not to eliminate the underlying risk tolerance that produced the failure in the first place. Time itself becomes an asset the institution holds and a resource regulators lend it, term-limited and renewable, in a way that is never extended to the individual account holders on the other end of a suspicious transaction, and never extended to the communities financing a drug war with capital that badly needed exactly this kind of channel to become spendable. This is the asymmetry embedded in every version of this pattern, not unique to HSBC. Who gains time? The institution, through monitorships, deferred agreements, and staged remediation timelines. Who gains optionality? Executives, who retain the ability to move to other roles, other institutions, largely unconstrained by a settlement that named the institution rather than them individually. Who gains political flexibility? Regulators, who can point to a record penalty as evidence of enforcement without testing whether a criminal conviction of a systemically important bank was actually as destabilizing as the untested assertion claimed. Who absorbs the cost without any comparable optionality? The account holders on the sending end of the laundered funds and the diffuse public that bears the risk of the next systemically important failure, priced not at all into the settlement figure.
The deeper question is not what happened at HSBC between 2006 and 2010. The deeper question is why the same structural conditions, deep interconnection to the correspondent banking system, a government reluctant to impose consequences that could ripple outward, an institution large enough that its balance sheet functions as an argument for leniency, persist unchanged. Minsky and Stabilizing an Unstable Economy, 1986, argued that financial systems become progressively more fragile not despite periods of stability, but because of them. Extended stability breeds greater risk tolerance among both institutions and their regulators, which increases the systemic cost of eventually addressing misconduct, which in turn increases the reluctance to address it decisively. Each round of too-big-to-jail reasoning doesn't just resolve one case, it raises the bar for what counts as consequential enough action the next time, because the institutions involved keep getting larger and more interconnected in the interim. You don't need to predict which institution triggers the next version of this pattern. The structural conditions that produced the HSBC outcome, size, interconnection, the political cost of disruption, the asymmetry between diffused public harm and concentrated institutional benefit, are not specific to banking in 2012. They are a description of how systemically important financial institutions relate to the states that regulate them, and that relationship has not been restructured since. The next time you hear that a major financial institution has reached a settlement, notice which word is doing the work. Settlement is not conviction. Deferred is not resolved. Fine is not, in HSBC's case, even accurate. It was a forfeiture of proceeds the bank had already admitted were tainted, dressed in language that made it sound like an ordinary punishment. You won't just be watching the number anymore. You'll be watching what the number is standing for, and who decided it should stand for something so much smaller that it appears. If you want more videos like this, subscribe.